All right, let's jump right into this explainer. Today, we're putting a true heavyweight on the stand, the $23 billion restaurant empire, Darden Restaurants. And we're not just doing a basic overview here. We're going to stress test this massive hospitality giant using the legendary investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. Plus, we'll throw in some modern discounted cash flow modeling for good measure. Think of this as the ultimate financial gauntlet for a stock.
To set the stage, Darden CEO Rick Cardenas recently came out swinging, bragging about a strong finish to an excellent year and massive industry outperformance. But you know us. Today, we're looking right past that confident CEO rhetoric and letting the cold, hard math do the talking. We want to know, is this stock actually a buy, or is the market serving up a dangerously overcooked valuation?
Here's our roadmap for today's analysis. We'll start with a quick company snapshot. Then view the stock through the Buffett lens, the Lynch lens, and the Graham lens, before running the quant models and wrapping it all up with our final verdict.
Starting things off with Section 1, our company snapshot of Darden Restaurants.
Trading under the ticker DRI, the stock is currently sitting at roughly $219.76 a share, and they are trading right near their 52-week high. If you didn't know, Darden is literally the largest restaurant operator in the U.S. full-service space. They completely dominate the casual dining market with 11 different brands, including absolute juggernauts like Olive Garden and LongHorn Steakhouse.
And just look at this top-line trajectory. Revenue just crossed the $13 billion mark for the first time ever, projecting to hit $13.21 billion in fiscal 2026. This isn't just luck. It's driven by really resilient same-restaurant sales, up about 4.5%, and some pretty aggressive expansion plans aiming for 75 to 80 new restaurant openings by fiscal 2027. So on paper, it's a phenomenal business.
Moving right along to Section 2, the Warren Buffett lens, where we look at moat, quality, and owner earnings.
So applying Buffett's principles here creates an immediate, fascinating tension. On one hand, Buffett would absolutely drool over Darden's stellar 53.7% return on equity. I mean, their consistent earnings and massive economies of scale act as a fantastic economic moat in a notoriously brutal industry. But, and it's a big but, he would probably despise their debt load. They have a debt-to-equity ratio of 3.65. Buffett loves a fortress balance sheet, and Darden relies pretty heavily on leverage to fuel its operations.
Then again, Buffett also loves cash. And looking at owner earnings, Darden generated a staggering $1.12 billion in free cash flow over the trailing 12 months. That gives them immense firepower to fund dividends and buybacks, including a newly authorized $1.5 billion share repurchase program. That's a massive checkmark for management quality and shareholder return. However, at its current price, Buffett would absolutely demand a wider margin of safety. He'd likely sit on his hands and wait for a pullback closer to the $150 range before even thinking about initiating a buy.
Next up, Section 3, the Peter Lynch lens, looking at categorization and the PEG ratio. Now, in Peter Lynch's universe, rule number 1 is know what you own. Lynch would definitely categorize Darden as a classic stalwart. You know, they aren't some high-flying, fast-growing tech startup. They're a mature cash cow aiming for a highly reliable 2.5 to 3.5% same-store sales growth. You buy a stalwart for steady gains and a little dividend protection when the economy gets rough.
But here's the crucial metric for Lynch. Darden's current PEG ratio, that's price to earnings relative to growth, is sitting at 2.19. Lynch famously preferred a PEG of 1.0 or lower. So a 2.19, that's a huge red flag, indicating you are vastly overpaying for Darden's current rate of growth.
Plus, we know Lynch loves unloved stocks, companies ignored by Wall Street where company insiders are actively buying up shares. Well, Darden fails both of those secondary tests too. It has near total institutional ownership at almost 98%, meaning Wall Street is fully, entirely aware of it. And on top of that, we're seeing recent insider selling of over 27,000 shares. Looking through the Lynch lens, this whole picture points squarely to a hold or even a sell.
Let's bring in the godfather of value investing for Section 4, the Benjamin Graham lens, and his defensive investor checklist. Benjamin Graham is all about maximum safety, right? Now, Darden easily passes his tests for adequate size, steady 10-year earning stability, and a genuinely fantastic dividend record. But it stumbles hard on the balance sheet. Its current ratio is just 0.31, which means its short-term liabilities vastly outweigh its short-term assets. Combine that with a sky-high price-to-book ratio of 11.39, and man, this would trigger major warning sirens for any Graham-style defensive investor.
Actually, if we crunch the numbers using Graham's specific intrinsic value formula, which remember is the square root of 22.5 multiplied by its EPS of $10.38 multiplied by its book value of $19.35, we get a fair value of exactly $67.22. Let that sink in for a second. Graham wouldn't touch this stock at its current $219 price tag. By his traditional deep value metrics, the margin of safety is practically non-existent.
All right, stepping away from the old school gurus, let's hit Section 5, Quant Models, focusing on DCF and alternative multiples.
Let's run a discounted cash flow sensitivity table. We're going to assume a 5% baseline growth rate for free cash flows, which completely aligns with their historical EBITDA trends. If we run varying discount rates, or WACC, against terminal growth, say using a standard 8% discount rate and a realistic 2.5% perpetual terminal growth rate, our base case fair value lands right around $188 per share. So even under modern Wall Street math, it's still significantly below where the stock is trading right now.
And honestly, when we cross-reference this DCF model with other valuation methods, the story stays exactly the same. A dividend discount model using their 648.4 dividend, that yields about $165. Looking at a comparable sector PE points to about $200. And if we model a reversion to their historical price-to-book ratios, we land at $150. No matter how you slice it, the consensus fair value range consistently hovers between $165 and $200.
Which brings us to our final act, Section 6, Synthesis and Verdict, where we bring the whole case together.
Pulling everything we've talked about together, the verdict is actually crystal clear. Look, Darden is an operationally phenomenal company. I mean, they have great margins, totally dominant market share, and incredible free cash flow. But as an investment right this second, every single valuation framework we applied screams that this asset is priced for absolute perfection. There is virtually zero margin of safety here. The Buffett and DCF models suggest a hold at best, waiting for a target price closer to that $150 to $180 range. Meanwhile, the Lynch and Graham models lean heavily towards a straight-up sell because of that high PEG ratio, the massive institutional ownership, and those weak balance sheet metrics.
So while you might absolutely love the endless breadsticks at Olive Garden, and hey, we can all applaud their operational excellence, we have to leave you with this final critical question for your own portfolio. Does Darden's premium valuation offer enough margin of safety for you, or is this simply a phenomenal company currently trading at a highly dangerous price? Think about it. Thanks for joining me on this explainer. Keep running the numbers, and I'll catch you on the next one.